Yes, people, good morning, good afternoon, good evening to South India student. How are you? Hope so you are good. I am also good. So guys, in the last lecture, we have discussed about the residential status and especially we have discussed about the residential status of the company. In case of company, like Indian company is always resident. In case of foreign company is resident only if the poem of that foreign company is located in India. If poem is not located in India, then that foreign company is a non-resident. Now guys, today we are going to discuss about the some special tax rate under section 115A and all, as well as we will discuss about some income deemed to be accrued or arise in India. So let's start with the scope of total income. So guys, there are two type of the income. One is the Indian income and one is the foreign income. Now what is the meaning of Indian income? So Indian income is either any income is received or deemed to be received in India. So any income which is first received or deemed to be received in India, that is called Indian income, or any income is accrued or deemed to be accrued in India is called your Indian income. So any income is accrued or deemed to be accrued or arise in India, that is called your Indian income. Now what is the meaning of foreign income? So guys, foreign income is income which is not an Indian income, that is called foreign income. So in simple word, can I say that if any income which is accrued outside India as well as received outside India, so accrued outside India as well as received outside India is called your foreign income. Now guys, for which person, which income is going to be taxable? So remember, if you are a resident and ordinarily resident in India now, then whole world income is taxable. Indian income is taxable as well as the foreign income from business control from India or foreign profession was set up in India, that income is also taxable, as well as the other foreign income is also taxable. So in simple word, if you are a R and OR na, then global income is taxable for you. If you are a R but NOR means resident but not ordinarily resident, then guys, Indian income is taxable, but as well as foreign income is taxable only if that business was controlled from India or foreign profession was set up in India, that income is taxable. Other foreign income is not taxable. And guys, for the non-resident, only Indian income is taxable, any other foreign income is not taxable. So in simple word, non-resident only Indian income is taxable, foreign income is not taxable, and Indian income is income accrued in India, income arise in India, or income deemed to be accrued or arise in India, or income received in India, that is called your Indian income. Now guys, this R and OR, R but NOR and all, that is only for individual and HUF. In case of the company, partnership firm, AOP, BOI and all, guys, there are only two concepts. One is the resident, one is the non-resident. So if any person is resident, then global income is taxable. If any person is non-resident, then only Indian income is taxable. Only Indian income is taxable. Now guys, let's start with one very interesting point, that is the section 9 or section 9 talk about the income deemed to be accrued or arise in India. You may feel that okay, this income is not accrued or arise in India, but there are certain income which are deemed to be accrued or arise in India. And under section 9 we will discuss certain provision, and first provision we are going to discuss about the indirect transfer or indirect transfer, or I can say that the Vodafone case law. If you remember little bit from our classes, then if you must remember about the Vodafone case law, I have explained you the Vodafone case law in class in very detailed manner. Okay, what happened in the Vodafone, what was the Vodafone case law? Earlier there was a company Hutchison and all. So let me explain you, let me revise you the Vodafone case law. So guys, what happened in the Vodafone case law? If you remember little bit, then guys try to understand. If you remember, in India, there was a one company, that company name was the Hutch SR Limited India. So this was the Indian company, but this is the subsidiary company of the one foreign company name is a CGP Investment Holding Limited, and this company was located in Cayman Island. And guys, this CGP Investment holds 67% shares of the Indian company. And guys, this CGP Investment Holding Limited, this company was a 100% subsidiary company of one Hong Kong based company. Name is a Hutchison Telecommunication Hong Kong Holding. Now, if you remember, I have mentioned that if any Indian company share got transferred, suppose Indian company share is transferred now, then obviously income is taxable in India. It is an Indian income because income is accrued or arise in India. But guys, what happened in the Vodafone case law? You know that this Hutchison Hong Kong, this company transferred the CGP share. CGP is a foreign company to third foreign company, that is Vodafone International Holding Limited, Netherlands. Means what happened in that particular case law? One Hong Kong based company transferring share of the Cayman Island based company to the Netherlands based company. Means there was involvement of the three foreign company. Means one foreign company is transferring share of another foreign company to the third foreign company. Now question is that is this transaction is taxable in India or not? Ultimately what happened? Indirectly they have transferred the control over the Hutchison. Indirectly they have transferred the control over the Indian Hutch company. but they transfer the shares of the foreign company, Cayman Island based company. So guys, is that transaction is taxable in India or not? That time what happened, Supreme Court gave the judgment and Supreme Court says that no, this is not taxable in India. But in 2012, that time our finance minister was Pranab Mukherjee. Pranab Mukherjee introduced the new amendment and Pranab Mukherjee says that no, this is also taxable in India. Now, how Pranab Mukherjee introduced the provision? So guys, Pranab Mukherjee inserted one section 9, and in the section 9, like he has inserted certain explanation. And now section 9 says that suppose if there is any foreign company and this foreign company derived value of its shares substantially from Indian asset, then foreign company share will be deemed to be located in India. And when it is deemed to be located in India, and if you transfer the foreign company share, then guys, it will be taxable in India. So now what is the law? Law says that if foreign company share derive its value substantially from the Indian asset, then foreign company share will be deemed to be located in India. And if you transfer this foreign company share, then income will be deemed to be accrued or arise in India, and now it is taxable in India. But now question is that, sir, when we will say that this foreign company derive its value from the Indian asset? So guys, there are two conditions. And that two condition is on the valuation date, this foreign company hold the Indian asset of more than 10 crore. Means this foreign company hold the Indian asset of more than 10 crore. That is the first condition. And second condition is like in whatever the total asset of this foreign company, in that total asset, at least 50% or more should be the Indian asset. If both the conditions are satisfied, then we can say that this foreign company derive its value from the Indian asset, and if you transfer the share of foreign company, then it is taxable in India. So what are the two conditions? First condition is this foreign company should hold Indian asset of more than 10 crore, means whatever the fair market value of Indian asset, that more than 10 crore asset should be held by the foreign company. And guys, whatever the total fair market value of the asset of this foreign company, in that total asset, at least 50% should be the Indian asset. If both the conditions are satisfied, then we can say that this foreign company share derive its value from Indian asset, and if you transfer the foreign company share, then it is taxable in India. But guys, there is one more point. Sir, this 10 crore and this 50% of total asset, 50% in total asset should be Indian asset. Sir, this we will check on which date? So guys, we have to check this condition on the valuation date. Now, what is the meaning of valuation date? So normally valuation date is a last balance sheet date. Suppose for an example, this CGP Investment Holding Limited, this foreign company share got transferred on 10th October 2024, and suppose they are following the financial year. So last balance sheet date is a 31st March 2024. So last balance sheet date is a valuation date. So last balance sheet date is called your valuation date. But guys, there is one exception. And that exception says that suppose if this foreign company book value of asset, what I am saying that book value of asset. Now book value of asset on the transfer date is more than at least 15% or more of the book value on last balance sheet date, then guys, transfer date will be treated as your valuation date. So guys, valuation date is normally a last balance sheet date is a valuation date, but there is a one exception on the transfer date. If book value of asset as compared to last balance sheet date book value, if on the date of transfer, if it is a 15% or more of the book value as on the last balance sheet date, in this particular case, your transfer date will be treated as valuation date. Now, one more exception is there, sir, suppose in this foreign company, if any person is holding equity share of only 5%, means interest is only 5% or less interest, and that person has not participated in any management and control in the last 12 months. In this particular case, if that share got transferred, then guys, capital gain is not applicable in India. If share got transferred, then capital gain is not applicable in India. Now guys, if you will read this example from this page, this Orange Limited of the USA and Grabs Limited, then you will able to understand this case law. Okay, so guys, this is the completion of your indirect transfer. Now let's start with the another portion or another interesting part from the section 9. In section 9, now next concept is related to the interest. Guys, interest. You know that we have already discussed that for the resident person, whole world income is taxable. Means you are a resident person, then global income is taxable. But non-resident, for non-resident, only Indian income is taxable. Now, Indian income is taxable. Indian income is either any income is accrued in India or arise in India or deemed to be accrued or arise in India or received in India or deemed to be received in India. That is called Indian income. Now, guys, there is a one section, that is the section 9, subsection 1, clause number 5, clause number 6 and clause number 7. All three clause we will discuss together. One is the interest, one is the royalty, one is the FTS. Now, guys, interest. When interest will be deemed to be accrued or arise in India, all people just focus here. I am going to explain you with the help of this example. All people pay attention. So guys, section 9, subsection 1, clause number 5 says that suppose if any person received any interest from the government, means this person, this non-resident, suppose there is a one example in the USA, there is a one person name is a Harry. Harry is a non-resident. Guys, for the resident person, anyway, all income is taxable now. For resident person, global income is taxable. So guys, we are talking about the non-resident. So in case of the non-resident or suppose foreign company, guys, suppose they have given the loan to the government and if they received any interest from the government now, then this interest is treated as deemed to be accrued or arise in India and it is taxable for the non-resident. Second it, suppose if this non-resident has given the loan to the any resident person, and interest is received from resident person now, then it is deemed to be accrued or arise in India and it is taxable for this person. But guys, there is a one exception. Exception says that suppose this resident person has used this money for any business or profession carried on by this assessee outside India or for earning any source of income from outside India, then this interest will not be treated as deemed to be accrued or arise in India for Mr. Harry. So all people pay attention, try to understand. Again, I am repeating, all people pay attention. Suppose there is a one person, name is a Harry. Harry is from USA, he is a non-resident. Now suppose Harry gave the loan to the government and he received the interest, then that interest is deemed to be accrued or arise in India. Suppose this Harry gave the loan to the any resident person in India. Assume resident person is Mr. BB is a resident person. And if we have given the interest to the Harry, then this in hands of Harry, it is a deemed to be accrued or arise in India. But guys, there is a one exception. Suppose this resident person used this money for any business or profession outside India or for earning any source of income from outside India, then this interest is not treated as deemed to be accrued or arise in India in hands of Mr. Harry. Now, third part is suppose this Harry, one non-resident, give the loan to the another non-resident, name is Mr. Sam, and Sam is located in Canada. If this loan is given to the Sam, then guys, if this Sam, this non-resident, use this money for any business or profession carried on by this non-resident in India, then guys, this interest is treated as deemed to be accrued or arise in India and it is going to be taxable in hands of Mr. Harry. So guys, there are three parts, all people pay attention. Now, this part, assume non-resident or like resident but not ordinarily resident or foreign company, because guys, if you are a resident and ordinarily resident, then anyway whole world income is taxable. But here we are talking about the non-resident, because for non-resident only Indian income is taxable. Now this income will be treated as deemed to be accrued or arise in India. It means it will be treated as the Indian income. So here lawmaker says that suppose if any non-resident or foreign company gives the loan to the government and received interest from the government, then this interest is deemed to be accrued or arise in India. If loan is given to any resident person and interest is received, then this interest is treated as deemed to be accrued or arise in India. But there is one exception. If this money is used by this resident person in any business or profession carried on by this person outside India or for earning any source of income from outside India, then this interest is not treated as deemed to be accrued or arise in India in hands of Mr. Harry. Now, third part is if loan is given to any other non-resident and if this non-resident used this money for any business or profession carried on by this non-resident in India, then this interest will be treated as deemed to be accrued or arise in India in hands of Mr. Harry. Now guys, we can take certain example, all people pay attention. Suppose there is one person, name is Mr. Harry. Harry is a non-resident or R but NOI. Now guys, this Harry gives the loan to Mr. BB, resident person. Now Mr. BB used this money for the business in Mumbai, then it is deemed to be accrued or arise in India. Answer is yes. In hands of Harry, this interest will be treated as deemed to be accrued or arise in India. Suppose Mr. BB used this money for any business or profession in Nepal, then it will not be treated as deemed to be accrued or arise in India in hands of Mr. Harry. But suppose BB used this money for buying a flat in Dubai. So buying a flat in Dubai, it means money is used for earning any income from any source located outside India. Then it will not be treated as deemed to be accrued or arise in India in hands of Mr. Harry. Now one more point, suppose I have purchased the shares of Indian company. So I took the loan from Mr. Harry and I have used in India, like I have purchased the share of Tata Limited, then this interest will be treated as deemed to be accrued or arise in India in hands of Mr. Harry. You got my point or not? Yes. Now one more point guys, one more example. Suppose there is a one guy, name is a Harry. Harry is a non-resident or Arbet Anwar. Now he give the loan to the Lobo. Lobo is also non-resident. Now here he is a non-resident, Lobo is also non-resident. Now Lobo used this money for any business in Canada. Then is this interest will be treated as deemed to be accrued or arise in India in hands of Harry? Answer is no, because this money is not used for any business or profession carried on by that borrower in India. So this is not treated as deemed to be accrued or arise in India. But suppose Lobo used this money for the business in Nagpur. So Nagpur is in India. Then guys, this interest will be treated as deemed to be accrued or arise in India for Mr. Harry. But suppose guys, this is interesting part. Lobo used this money for purchase the shares of Indian company. So shares of Indian company, that is Bajaj Finance Limited. Then question is that is this interest will be treated as deemed to be accrued or arise in India for Mr. Harry? Answer is no. Because what lawmaker says that if loan is given to another non-resident and that another non-resident invested or that money is used for any business or profession carried on by this non-resident in India, then only it will be treated as deemed to be accrued or arise in India. Here guys, Lobo is not doing any business or profession in India. If he used to do the business and he used that money for any business and profession in India, then only it will be treated as deemed to be accrued or arise in India. Otherwise it is not going to be treated as deemed to be accrued or arise in India. You got my point or not? You understood my point or not? Yes sir, we have understood. Now next part is related to royalty and FTS. Now question is that what is the meaning of the royalty? So guys, whenever any intangible is supplied, intangible means any patent, copyright, trademark, franchisee, design, formula, any like you know that technical know-how and all, if that is transfer for the limited purpose, guys, if it is like 100% is transfer, then capital gain will arise. If it is capital gain is applicable, then obviously it is not covered in the royalty. But otherwise, if capital gain is not applicable and if it is transfer for the limited period or limited purpose or some right is transferred, then guys, it will be treated as the royalty. Now lawmaker says that suppose for an example, if any non-resident, example is the USA, there is a one person, name is Elon Musk. He is from USA, non-resident. Now suppose this person has given any service to the government and he is receiving royalty or FTS from government, then this royalty FTS is going to be deemed to be accrued or arise in India and it is taxable for the Elon Musk. Now second, suppose Elon Musk provided the service, that is fees for technical service or any services provided, and to the resident person, example is a Tata Motors, and he received the royalty FTS from the Tata Motors, then guys, it will be treated as deemed to be accrued or arise in India. But guys, there is a one exception case. Suppose Tata Motors use this service or right for any business or profession outside India or for earning any income from any source located outside India, then it will not be treated as deemed to be accrued or arise in India in hands of the Elon Musk. Now next part, suppose Elon Musk provided this service to any non-resident, example is a Putin, and this Putin used this service or right used for any business or profession in India, or here it is included for earning any source of income from India, then guys, this royalty FTS will be taxable in India in hands of the Elon Musk, means it will be treated as deemed to be accrued or arise in India. So simple word I can say that suppose if there is a non-resident foreign company, because guys, why I am talking again and again non-resident foreign company, because for resident person whole world income is taxable, whether it is accrued or arise in India or not, everything is taxable. But we are concerning about my non-resident, because for non-resident only Indian income is taxable. So that's why I am saying again and again here non-resident, but ultimately in the law they have not mentioned here non-resident. In the law it is mentioned that this income is treated as deemed to be accrued or arise in India. So in simple word I am saying that suppose non-resident or foreign company provided any service to government and they receive the royalty FTS, it is deemed to be accrued or arise in India. They have provided the service to the any resident person, then it is deemed to be accrued or arise in India. But in case of resident person, there is a one exception. If that resident person use that service or right in any business or profession carried on outside India, or for earning any source of income from outside India, then it is not treated as deemed to be accrued or arise in India. And third, if any services provided to the non-resident, and guys, any services provided to the non-resident and that non-resident use that service or right in any business or profession carried on in India by that non-resident, or for earning any source of income in India, then it will be treated as deemed to be accrued or arise in India. You got my point or not? Yes. Okay, one more point, guys. When you will read from your book now, then guys, here royalty definition is given. Okay, what do you mean by the royalty? So royalty means transfer of all or any right, including the granting of license in respect of the patent or invention or model, design, secret formula, process, trademark, similar property, or guys, imparting any information means you have transferred the model, design, secret formula, patent and all, but you are also imparting the any information that how this will work, means working of or the use of or the patent, invention, model, design, secret formula, etc., etc. It will also be treated as deemed to be accrued or arise in, like it will be treated as the royalty. Now next is use of any patent. Like suppose you have given the use of any patent to any person, then whatever amount you received, that is called royalty. Or imparting any information related to technical or industrial or commercial or scientific knowledge, experience or skill. And guys, if you give any industrial, commercial or scientific equipment on the rental basis, then that rent will also be treated as the royalty. That will also be treated as the royalty. After that, remember guys, if any software is transferred, then it will be covered in the royalty. So if any software is transferred, then it will be covered in the royalty. But guys, there is a one exception case. There is a one notification. This notification says that suppose for an example, if there is a resale of the software, means for an example, there is a one company called Microsoft. Microsoft produce one software, they manufacture one software, and guys, that Microsoft sold that software to, for an example, there is a one company name is a TechEnd. Suppose Microsoft sold this software to the TechEnd, and TechEnd has deducted the TDS of the Microsoft. Now suppose this TechEnd has just sold, resale that software without any change, means as use, like as it is, they are selling, TechEnd is selling that software to the third party, then guys, TDS is not applicable. That we have already discussed under the TDS topic also. And now what is the meaning of the technical service? So guys, fees for technical service they have given here. Okay, what do you mean by the fees for technical service? So fees for technical service means any managerial service, technical service, consultancy service. But guys, if any income which is taxable under the head salary, that is not going to be covered in the fees for technical service. You got my point or not? Yes. Now guys, we are going to start with the tax rate. Okay, sir, how this interest will be taxable, how this royalty will be taxable, and how this fees for technical service will be taxable for the non-resident. So let's start with the one section, that is the section 115A. Now guys, let's start with section 115A. And 115A is basically some special tax rates for the non-resident as well as the foreign company. So guys, we have discussed that when interest is deemed to be accrued or arise in India and all. So guys, if any non-resident foreign company received the interest, then what is the tax rate for the interest, means how interest is going to be taxable. So all people pay attention. Let's start with the interest first. So guys, here first point says that suppose if any non-resident or foreign company received interest from any infrastructure debt fund. Infrastructure debt fund means debt fund which is mentioned under section 10 clause number 47 is called infrastructure debt fund. Then guys, the tax rate is a 5% in hands of non-resident foreign company, and TDS rate is also 5% under section 194 LB. So guys, infrastructure debt fund means in India there are certain debt fund. They used to take the loan from the non-resident foreign company. So if non-resident foreign company invested in the infrastructure debt fund invest in the infrastructure market. So infrastructure debt fund gives the interest to the non-resident foreign company. Then guys, this interest is going to be taxable in hands of non-resident foreign company at the rate 5%, and TDS is also applicable under section 194 LB at the rate 5%. Now second point is, suppose guys, non-resident foreign company gives the foreign currency loan to any Indian company or a business trust under the loan agreement between 1st July 2012 till 30th June 2023. So guys, if non-resident foreign company gives the foreign currency loan to the any Indian company or a business trust, and loan agreement has been signed between 1st July 2012 till 30th June 2023. or suppose by way of the long-term bonds, or by way of the long-term bonds means non-resident foreign company subscribe the long-term bonds of Indian company or business trust till 30th June 2023, or rupee denominated bonds of Indian company or business trust till 30th June 2023. And guys, whatever interest is received by non-resident foreign company na, that interest is taxable at the rate 5%. And here guys, TDS is also applicable at the rate 5% under section 194 LC. So here in simple words, suppose if any Indian company or business trust took the foreign currency loan from non-resident or foreign company and agreement is signed till 30th June 2023, or long-term bond issued till 30th June 2023, or rupee denominated bonds issued till 30th June 2023, then guys, whatever interest is paid by like Indian company or business trust to non-resident foreign company, that interest is taxable at the rate 5% in hands of non-resident foreign company. And guys, TDS is also applicable at the rate 5% under section 194 LC. But guys, there is a one exception, and that exception says that, okay, guys, here note number 4, and note number 4 says that, okay, suppose for an example, tax rate and TDS rate is 4% instead of 5% in respect of money borrowed by it, means Indian company or business trust, from source outside India by way of issue of long-term bonds or rupee denominated bonds on or after 1st April 2020 till 30th June 2023. And guys, these bonds are listed only in the recognized stock exchange located in the IFSC. Then guys, here TDS rate as well as tax rate is a 4% instead of 5%. So here guys, if money is borrowed by the Indian company or business trust through the long-term bonds or rupee denominated bonds, and between 1st April 2020 till 30th June 2023, and guys, these bonds are listed only in the recognized stock exchange located in the International Financial Service Center in Gujarat, Gandhinagar, then guys, here tax rate is a 4% instead of the 5%. And guys, if it is issued on or after 1st July 2023, then tax rate and TDS rate is the 9%. Tax rate and TDS rate is a 9%. You got my point or not? You understood my point or not? Yes, sir. We have understood your point. So what is the second point? Second point says that suppose any Indian company or business trust took the loan from the non-resident foreign company, that is foreign currency loan, agreement has been signed till 30th June 2023, or long-term bonds issued till 30th June 2023, or rupee denominated bonds issued till 30th June 2023, then guys, tax rate is 5% and here TDS rate is also 5%. Their tax rate is 5%, TDS rate is 5%. But there is a one exception, okay, guys, if long-term bonds or rupee denominated bond issued between 1st April 2020 till 30th June 2023 and it is listed only in the recognized stock exchange located in IFSC, then here tax rate and TDS rate is 4% instead of 5%. But if it is issued on or after 1st July 2023, then here tax rate and TDS rate is 9%. You got my point or not? Yes. Now guys, there is a one more point. There is a one exception that is given under section 10(4)(c). Now what is the 10(4)(c) if you remember? So here guys, let's discuss the 10(4)(c). 10(4)(c) says that, yes, suppose non-resident and foreign company, they are getting the interest, and they are getting interest from, so interest is payable by Indian company or a business trust in respect of money borrowed by Indian company or business trust from outside India by way of rupee denominated bonds. And that rupee denominated bonds is issued between 17th September 2018 till 30th September 2019. Then whatever interest is received by this non-resident foreign company, that is always exempted. So guys, there was a one, you know that there was a one tax-free window, you can say that, and 17th September 2018 is a Modi ji's birthday, our Modi ji's Prime Minister Modi ji's birthday. So from the Modi ji's birthday till 31st March 2019. So Modi ji's birthday, that is 17th September 2018 till 31st March 2019. So 31st March 2019, so 17th September 2018 till 31st March 2019, if rupee denominated bonds or rupee denominated bonds is issued by Indian company or business trust to non-resident foreign company, then guys, for the lifetime, whatever interest they will receive, that interest is totally exempted. That interest is totally exempted. It is not taxable at even 5%. It is totally exempted. You got my point or not? Yes. Now guys, again let's check the section 115A. What 115A says that. So two part we have covered. Now third part says that, yes, suppose if any interest or dividend is received by non-resident unit holder from the business trust and business trust received that interest from the SPV, Guys, that we already covered in the business trust. Now, if you remember that business trust received the interest from the SPV, then that interest is taxable in hands of non-resident foreign company at the rate 5%. TDS is also applicable at the rate 5% under section 194 LBA. Or guys, suppose SPV paid the taxes under section 115 BAA and SPV pay the dividend to business trust and same dividend is paid to the non-resident foreign company, then it is taxable at the rate 10% and TDS is also applicable at the rate 10% under section 194 LBA. Now last part, guys, this point you have to cut it up because this is not applicable now. It was applicable till last year, now it is not applicable, so just cut it, as well as this note number 3 also, this line also you have to cut it. Now next part, last point says that suppose if any interest is received by non-resident foreign company from the government or any Indian concern or on foreign currency loan, and if it is not covered in this and this. So non-resident foreign company gives the loan to Indian government or any Indian concern, foreign currency loan, and it is not covered in part A, part B, part C is not applicable, part D. So it is not covered in all this 3. Then guys, interest is received by non-resident foreign company on the foreign currency loan. That is going to be taxable at the rate 20% under section 115A. So we have discussed about the interest. Now next part is, suppose guys, if any non-resident foreign company receive the dividend, then if non-resident foreign company receive the dividend, then guys, this dividend is taxable at the rate 10%, not 10%, 20%. The 10% dividend is only here. Here it was a 10% dividend in case of that SPV business trust and all. But guys, here this dividend is received now, then dividend is taxable at the rate 20%. But here this dividend will be 10%. Here this dividend will be 10% if it is received from any unit located in the International Financial Service Center, or I can say that IFSC. Now suppose if non-resident foreign company received any income from any UTI mutual fund. UTI mutual fund means Unit Trust of India mutual fund. Income is received, that is like a dividend only. That is taxable as per 20%. You got my point or not? Yes. So dividend is also taxable at the rate 20%. Income from UTI mutual fund is also taxable as per 20%. Now let's start with the royalty FTS. So guys, if any non-resident foreign company receive the royalty or FTS, fees for technical service, when it will be deemed to be accrued or arise in India and all, that we have already discussed. So if any non-resident foreign company receive the royalty or FTS, then guys, it is going to be taxable in hands of non-resident foreign company. But sir, if it is taxable, then how it is going to be taxable? So guys, there are 2 parts. All people pay attention. Remember, if non-resident or foreign company, if they receive the royalty FTS from the India, then you have to check that if this non-resident foreign company is having the P in India or not. P means permanent establishment in India. So suppose guys, if that non-resident or foreign company is having the P in India, P in India means they are having the branch, they are having the office in India. Then guys, this non-resident foreign company, they will prepare the profit and loss account of this P. Means they will prepare the profit and loss account of this PE, and royalty and FTS will be credited to the P&L debit credit side. Royalty, FTS will be credited to the credit side of the P&L. And guys, in this particular case, whatever the income, that income, normally income you will calculate, and this income will be taxable as per the normal tax rate. Suppose if there is a non-resident, then obviously that income will be taxable as per the slab rate. Suppose if there is a foreign company, that income is going to be taxable at the rate 35% because foreign company tax rate is 35%. But remember here, in case of the non-resident foreign company is having the PE, then income will be taxable as per the normal tax rate. Means royalty FTS is going to be taxable as per normal tax rate. But remember, in the debit side, they cannot put 2 types of the expenditure. One is the any expenditure which is not wholly and exclusively for the Indian business. Any expenditure which is not wholly or exclusively for attributed to the Indian PE, that expenditure will not be allowed in the P&L debit side. And guys, one more point, suppose for an example, if this PE is paying any amount to the another PE or their head office, that is not allowed. But if there is a reimbursement of the actual expenditure, now that will be allowed. Otherwise, that any expenditure is paid to head office or any another PE, that is not allowed as deduction in the P&L debit side. One more point guys, here I am saying that this income is going to be taxable as per the normal tax rate. So suppose non-resident is an individual, then it will be taxable as per the slab rate. But suppose if that non-resident is a like foreign company, then obviously it is going to be taxable as per 35%. But next part is suppose if that non-resident foreign company is not having the PE in India. If that non-resident foreign company is not having the PE in India, if this non-resident foreign company is not having the PE in India, then guys, this royalty FTS is going to be taxable as per 20%. This royalty FTS is going to be taxable as per 20%. This royalty FTS is going to be taxable at per 20%, and this gross income is taxable at per 20%. So what I am saying that try to understand here, guys, we are going to discuss about the royalty FTS. So under section 115A, royalty FTS received by non-resident foreign company, if it is received from the government in pursuance of any agreement with the government, or if it is received from any Indian concern, as per the agreement made by non-resident foreign company with Indian concern, and agreement is approved by the government, then guys, this royalty FTS is taxable as per 20%. But suppose DTAA rate is lower, then it will be taxable as per the lower rate. So DTAA rate or 20%, whichever is more beneficial, at that rate it is going to be taxable. You got my point or not? Yes. Okay, one more point, guys. If non-resident or foreign company, if that non-resident or foreign company is received only interest income or dividend income or royalty FTS, and that is taxable as per section 115A, and if TDS is already deducted, then they are not required to file their return of income. They are not required to file their return of income. So this is the completion of section 115A. Now next section is section 115AB. 115AB is related to the OFO. OFO means Overseas Financial Organization. 115AB is related to the OFO. OFO means Overseas Financial Organization. Overseas Financial Organization means there is a organization, they are located outside India, but they have invested in India in the mutual fund UTI. So guys, if Overseas Financial Organization, they are received any income, it is an interest income from UTI mutual fund, or if there is a long-term capital gain on the transfer of the unit of the UTI or mutual fund, then guys, their tax rate is a 10%. 10% is tax rate. So even if it is an interest income, then it is taxable as per 10%, as well as there is a long-term capital gain on the transfer of the UTI mutual fund unit, then it is taxable as per 10%. But guys, there is a change from 23rd of July 2024. So with effect from 23rd July 2024, if there is a long-term capital gain, then that long-term capital gain will be taxable as per 12.5%. It is not taxable as per 10%. It is going to be taxable as per 12.5%. So 12.5% is the tax rate on the long-term capital gain. So section 115AB says that suppose for an example, there is a OFO. OFO means Overseas Financial Organization. They are having the interest income from UTI mutual fund, or they are interest, basically interest or dividend, you can say that, from UTI mutual fund, or there is a long-term capital gain that is taxable as per 10%. And guys, if there is a long-term capital gain on or after 23rd July 2024, tax rate will be 12.5% instead of the 10%. You got my point or not? Yes. Now next section is a 115AC. This 115AC says that suppose guys, if that non-resident invested in the GDR or bonds of Indian company. So non-resident invested in the GDR means Global Depository Receipt. So if non-resident invested in the bonds of Indian company, here guys, bonds are covered as FCCB. FCCB means, you know that there are foreign currency convertible bond. So if non-resident invested in the bonds of Indian company, that is the FCCB, foreign currency convertible bond, or GDR, and that non-resident is acquired in the foreign currency, and guys, on that bonds, if he received the interest, that income, that interest or dividend, that is taxable as per 10%, and long-term capital gain is also taxable as per 10%. But guys, long-term capital gain, that tax rate is at 12.5% with effect from 23rd July 2024. So from 23rd July 2024, that long-term capital gain is taxable as per 12.5% instead of the 10%. You got my point or not? Yes. Now one more point. Guys, suppose that non-resident is having only interest income or dividend income, and if TDS is already deducted, then that non-resident foreign company is not required to file any return in India. You got my point or not? Yes. This is the section 115AC. Now guys, there is a one more section, that is the section 115AC. But if you will not remember this section, then also it is okay. This is not for non-resident, it is for the resident person. So suppose guys, if there is a resident employee, and that resident employee is working in IT software service industry, or any entertainment service, pharmaceutical industry, or biotechnology industry, and they receive the ESOP. And under ESOP, if they receive the GDR, under ESOP they receive the GDR, and on that GDR, if they received any dividend, then dividend is taxable as per 10%. If there is a long-term capital gain, that is also taxable as per 10%. But on the long-term capital gain, obviously tax rate is 12.5% with effect from 23rd July 2024. So if you will remember this, then it's okay. If you will not remember, then also it is okay. So guys, we have discussed the three section. Just you have to remember the three section: 115A, 115AB, and 115AC. Now, what we have discussed under section 115A, let me revise. All people pay attention. All people pay attention. So guys, you know that 115A says that a non-resident foreign company invested in the infrastructure debt fund, they receive the interest. Its tax rate is 5%. TDS rate is also 5%. Now, non-resident foreign company gives the foreign currency loan to the Indian company or business trust, and loan agreement is signed till 30th June 2023, or long-term bonds issued till 30th June 2023, or rupee denominated bonds issued till 30th June 2023. Then guys, here that tax rate is 5% on the interest. So here TDS rate is also 5%. But guys, there is one exception from Modi ji birthday till 31st March 2019. That 18 Modi ji birthday, 17 September 2018 till 31st March 2019. If RDB is issued, then interest is always exempt. Now guys, if RDB or long-term bonds issued between 1st April 2020 till 30th June 2023 and listed in only recognized stock exchange and IFSC, then tax rate is 4% instead of 5%. And if it is issued on or after 1st July 2023, then tax rate is 9%. After that, we have discussed that non-resident foreign company from business trust, and business trust paid the interest which was received from SPV, then tax rate is 5%, TDS rate is 5%, dividend tax rate is 10%, TDS rate is 10%. If non-resident foreign company gives the foreign currency loan to any Indian concern or government, then tax rate is 20%. Now, one more point guys, if non-resident foreign company receive the dividend or income from UTI mutual fund, then tax rate is 20%. After that, we have discussed one section 115AB. 115AB says that suppose overseas financial organization, they have invested in the mutual fund UTI and they receive the income, that is interest or dividend, it is taxable as per 10%. Long-term capital gain is also taxable as per 10%, but with effect from 23rd July 2024, the tax rate is 12.5%. Now guys, one more point we have discussed 115AC. If non-resident invested in the GDR or bonds of Indian company, then interest income or dividend taxable as per 10%. Long-term capital gain is also taxable as per 10%. But guys, there was one exceptional case, if long-term capital gain is on or after 23rd July 2024, then it is taxable as per 12.5%. Now guys, last one more point. And this is related to the FII. Guys, FII means foreign institutional investor. Now guys, in case of the FII, foreign institutional investor, guys, if FII is having any income from security in India, any income on the security other than UTI mutual fund unit, because UTI mutual fund unit will be covered in the OFO, because FII is also considered as OFO only, overseas financial organization. So guys, if any FII received any income on the security, then guys, how it will be taxable? You know that it is going to be taxable as per 10%, 20%, and 30%. What I am saying, 10%, 20%, 30%. So FII received the income. FII received the income on the security from India, then it is taxable as per 10%, 20%, and 30%. Long-term capital gain 10%. Investment income 20%, and guys, if there is a short-term capital gain, then 30%. So there is a section 115AD. What 115AD say? Again, I am repeating. If FII received the income on the security, if there is a long-term capital gain 10%, if there is a interest income, then 20%, if there is a short-term capital gain, then 30%. Again, I am repeating here. So long-term capital gain, then 10%. If there is an investment income, then 20%, short-term capital gain, then 30%. But one more point, guys. Here I am saying that long-term capital gain on the security, then 10%. Investment income, then 20%, short-term capital gain, then 30%. But guys, suppose if there is a short-term capital gain under section 111A, then short-term capital gain earlier taxable at the rate 15%, but on or after 23rd July 2024, it is taxable as per 20%. Now guys, here I am saying long-term capital gain is 10%. Sir, is there a change in the rate on the long-term capital gain under this section or not? Answer is no, guys. Lawmakers made one mistake in this section. lawmakers made one unintentional mistake. There is a mistake in the law, but in the next year 2025 finance bill they have already rectified that mistake. But guys, here they mentioned that tax rate is a 10% for whole year, means long term capital gain on transfer of any security, 10% is tax rate. But guys, if section 112A applicable here, if 112A applicable, and if it is transferred till 22nd July 2024, means before 23rd July 2024, then tax rate is 10%. If it is transferred on or after 23rd July 2024, then tax rate is at 12.5%. But in excess of 1,25,000, that 1,25,000 benefit is available under this particular section. So what I have mentioned, all people try to understand. I can explain you from your book also. There is a section 115AD. What 115AD says, try to understand. Because if there are certain correction, because if you receive the book and there is no correction in that book, then please make this correction. All people pay attention. Here, first 115AD, just understand from FII perspective, foreign institutional investor. So foreign institutional investor received the income on security other than UTI mutual fund. If there is a long-term capital gain, then 10%. But guys, their exception is 12.5% if asset transfer on or after 23rd July 2024 and 112A apply. If 112A apply, then only 12.5%. Otherwise, it is for whole year, it is a 10%. Short-term capital gain 30%. Interest income, interest dividend income 20%, and short-term capital gain 111A 15%. But guys, on or after 23rd July 2024, then it is a 20%. You got my point or not? Yes. Okay, one more point. Guys, under this section, if 112A apply, then it is 10% or 12.5% in excess of 1,25,000. Now, under this section, they have mentioned about the specified fund also. Now, what do you mean by the specified fund? So, sir, guys, specified fund means basically alternate investment fund category 3. Alternate investment fund category 3, and which is located in the IFSC, and all the unit holder of that specified fund are non-resident. All the unit holder are non-resident. That is called your specified fund. Now guys, in case of a specified fund, for the specified fund, tax rate is the same, but there is a one difference. We have discussed that for FII there is a 10%, 20%, 30%. Means long-term capital gain 10%, investment income 20%, short-term capital gain 30%. But guys, for the specified fund, it is a 10%, 10% and 30%. Means long-term capital gain 10%. After that, investment income, that is the interest and dividend, that is 10% instead of 20%. And guys, short-term capital gain is 30%. But guys, for the specified fund, there are certain income which are totally exempted, and where it is mentioned which income is exempted and all, that is given under section 10.4D. So if you will read the from exemption part 10.4D, then you will able to understand that this income are exempted, but other income are taxable, and it will be taxable long-term capital gain 10%. Investment income, then also it is taxable as per 10%. And guys, if there is a short-term capital gain, it is taxable at 30%. But if 112A and 111A, then it will be taxable as per section 112A or 111A. You got my point or not? Yes. So if you will not able to remember the specified fund, then also I think it will be okay. ICI is not going to ask the question on the specified fund, but they may ask the question on the FII. You got my point or not? Yes. Now guys, there is a one more special case, special section, that is the 115BBA. And 115BBA is very simple section. 115BBA, we have discussed in your that TDS topic also under section 194E. You know that. Suppose for an example, if any non-resident sports person or sports association or non-resident entertainer, and non-resident sports person and entertainer should be non-Indian citizen also, if they received any money from India for participating any game in India, or for the advertisement in India, or writing a newspaper article in the newspaper and all, or entertainer perform in the India, and he received any amount, then guys, you know that under section 194E, that TDS rate was 20%. This section says that tax rate is at 20%. This section says that tax rate is at 20%. Their TDS rate was 20%. Here tax rate is a 20%. You got my point or not? And one more point, guys. Here, whatever section we have discussed now, there's a special rate of section from 115A, 115AB, 115AC, 115AD, 115BBA. Guys, this all section are the mandatory section. And one more point, guys, this all section are mandatory section, and against this income, like whatever income taxable under section 115A or 115AB or 115AC or 115AD, guys, against this income any expenditure is not allowed. Means expenditure under section 28 to 44C or 57, expenditure is not allowed. Means gross income is taxable. One more point, any deduction under chapter 6A is not allowed, but only two deduction is allowed. One is the against royalty FTS, you can claim the deduction. Against royalty FTS, which is taxable under section 115A, you can claim the deduction. And one is the deduction under section 80LA is available. 80LA is basically if any unit is located in the IFSC na, then for the 10 year there is no need to pay the tax. So under section 80LA you can claim the deduction. One more point, guys, indexation benefit is not available, as well as first proviso to section 48 is not available. Indexation benefit is not available. It means, guys, that second proviso to section, and nowadays anyway indexation is not available if you transfer on or after 23rd July 2024. But if you transfer before that, then also indexation benefit is not available, as well as that conversion, that in case of non-resident, you know that for calculating capital gain you convert into foreign currency, that is also not available. You got my point or not? Yes. And guys, against the special rate of income, that basic exemption benefit is not available. Basic exemption benefit is not available against the special rate of income. Done. So this is all about the 115A, 115AB, 115AC and 115AD. Now let's start with one very interesting or very small concept is related to NRI. Yes, people. So next concept is related to the NRI. NRI means non-resident Indian. So NRI. So guys, NRI means non-resident Indian. So for NRI, there is a one chapter, that is chapter number 12A. And guys, this chapter is applicable only for the NRI. And this chapter is optional. Now, what is the chapter? I will explain you. So first question is, sir, what is the meaning of the NRI? So NRI means if any individual is a non-resident plus he is an Indian citizen or person of Indian origin. So in simple word, any individual, he is a non-resident, but along with the non-resident, that person is either Indian citizen or person of Indian origin, either Indian citizen or person of Indian origin, that person is known as the NRI. Now, what is the meaning of person of Indian origin? Person of Indian origin means either of the parents or grandparent was born in India is called person of Indian origin. So in simple word, that person is a non-resident, means as per residential status, he is not satisfying any condition of the 6(1). So he is a non-resident, and plus he is the Indian citizen or person of Indian origin, then that person is called your NRI. Now guys, in case of the NRI, if NRI received income on the forex asset. Now what is the meaning of the forex asset? So forex asset means, guys, NRI has acquired this asset in the convertible foreign exchange. Then it is known as the forex asset. Now which asset? One is the, if he purchased the shares of any Indian company. Shares of Indian company means either public company or private company, share of Indian company, or debenture of the Indian public company, or deposit with the Indian public company, or I can say that debenture or deposit of Indian public company, or if he purchased the any security of the central government. So what I'm saying that if NRI has invested in the forex asset means one is the shares of Indian company, any Indian company, or deposit or debenture of the Indian public company, or any security of the central government, and he has purchased this asset in the convertible foreign exchange, then it is known as the forex asset. Now guys, in case of the forex asset, if he is received any income, then this income will be taxable as per the special rate under section 115E. And what is the special rate here? Special rate is, guys, in case of the investment income. So if he receive the investment income on this asset, investment income is debenture, dividend or interest and all, then it is taxable as per 20%. And if there is a long-term capital gain, then that long-term capital gain is taxable as per 10%, but it will be 12.5% with effect from 23rd July 2024. So in simple word, guys, if NRI is having the NRI invested in the forex asset means shares of Indian company, or the debenture of Indian public company, or deposit with the Indian public company, or any security of the central government. And on this, if there is a investment income is interest or dividend, that is taxable as per 20%. And guys, long-term capital gain, then it is taxable as per 10%, 12.5% if transfer took place on or after 23rd July 2024. And if there is any other income other than this two income, that will be taxable as per the normal tax rate. Now guys, for the two income, there is a special rate. One is the investment income 20%, LTCG 10% or 12.5%. But again, this investment income, any expenditure is not allowed. Means any expenditure under section 28 to 44C or section 57, that any expenditure is not allowed, means investment income will be taxable on the gross basis. One more point guys, deduction under chapter 6A is not allowed. And guys, if there is a long-term capital gain, then against long-term capital gain also deduction under chapter 6A is not allowed. But against long-term capital gain, while calculating the long-term capital gain, sir, is there is any transfer expenses is allowed? Answer is yes, transfer expenses will allow. Cost of acquisition, cost of improvement, cost of acquisition basically, that will allow. One more point guys, that first proviso to section 48 was like, you know, that if like in case of non-resident or foreign company, we used to like calculate capital gain in foreign currency and after that reconvert into the Indian currency. That proviso is available. Answer is yes, but index benefit is not available. So what I'm saying that, okay, guys, in case of the NRI, if NRI has acquired this asset in the foreign currency, then guys, on this asset, if there is an investment income, that is taxable as per 20%. If there is a long-term capital gain, then it is taxable as per 10% or 12.5% if it is transferred on or after 23rd July 2024. But now there will be one question in your mind, okay, sir, you are saying long-term capital gain is taxable as per 10% or 12.5%. But suppose if it is a long-term capital gain under section 112A, so sir, under section 112A, that 1,25,000 benefit is available. Here it is available or not? Answer is no, guys. When long-term capital gain is taxable as per section 115E, then that 1,25,000 benefit is not available. That is available only when? Like 112A is applicable. Here 112A is not applicable. Here section 115E is applicable. And as per section 115E, it is very simple. Long-term capital gain 10% or 12.5% on or after 23rd July 2024. So even listed share are transfer. And you are opting this provision in this particular case, guys, that 1,25,000 benefit is not available. Here it will be taxable at the flat rate of 10% or 12.5%. Now one more point, guys, suppose if you transfer the one forex asset and within the period of the 6 months from the date of transfer, if you acquire the another forex asset, or if you have acquired the another forex asset, or if you have invested in the savings certificate notified under section 10(4)(b), then guys, that long-term capital gain will be exempt. So either if you transfer the long-term capital asset and there is a long-term capital gain within the period of 6 months, if you have invested in the another forex asset or any savings certificate notified under section 10(4)(b) within the period of 6 months, then capital gain is exempted. But how it will be exempted? It will be exempted as per the formula. That formula is like a 54F formula. You know that if net consideration is fully utilized, then capital gain is fully exempt. If net consideration is partly utilized, then capital gain is partly exempt as per the formula, and formula is LTCG multiplied by cost of new asset divided by net consideration. One more point, new forex asset you should not be transferred within the period of 3 years from the date of its acquisition. If it is transferred within 3 years, then whatever exemption claim earlier, that will be withdrawn and it will be treated as the long-term capital gain in the year of the violation. You got my point or not? Yes. One more point, guys, suppose if NRI is having only this two income, one is the only he is having the two income, investment income and LTCG, and he don't have any other income in India, then guys, he is not required to file his return also in India. There is no need to file the return. Okay, one more point, guys, suppose earlier that person was NRI, so NRI means that person was non-resident, but suppose in the current year he became the resident. So question is that suppose he became the resident, then also can he continue to follow the provision of this chapter? Means can he continue to pay the tax on the investment income at the rate 20%? Answer is yes, guys. So suppose if any person, he was the non-resident earlier, he was the NRI, but he became the resident, then also if he wished, then he can continue to follow the provision of this chapter and he can pay the tax on the investment income at the rate 20% till the time he is having that forex asset. But suppose forex asset is transferred, then obviously there is no provision to continue with this provision, this chapter provision. So till the time he is having the forex asset on the investment income, he can pay the tax at the rate 20%. Okay, one more point, guys, for the NRI, this chapter is the optional, means either he want to follow the chapter number 12a or he can go with the continue with the normal provision. Suppose for an example, for the dividend and interest and all, suppose he is not following this provision, then how dividend will be taxable? Then dividend will be taxable for the, because assessee is a non-resident na, then anyway it will be taxable under section 115a at the rate 20%. Because under section 115a we have discussed that non-resident foreign company receive any interest from foreign currency loan and all, then 20%. Dividend from Indian company, then it is 20%. So anyway, it is going to be taxable as per 20%. You got my point or not? Yes. So guys, in the today's lecture, we have discussed the special tax rate as well as we have discussed the royalty, FTS and Vodafone case law. So this much portion from the non-resident taxation is important for your examination. You should do all the question from your compiler. Maximum question you can easily do on the basis of this revision. Okay, and in the last revision lecture we have discussed about the residential status of the company, that poem concept, that is also relevant for your examination, and we are expecting this time 8 to 10 mark question from the non-resident taxation. Okay, bye, take care.